Hey everybody, it's Colby, the DGI Crab, and we've had another stock just absolutely take a massive 20% plus dip, and that is Target. They reported very disappointing Q3 earnings yesterday. The stock is down massively, more than 20%, and back again here to talk to you about how I look at these things when high quality blue chip stocks take a tumble. I'm not offering you financial advice. I'm not a licensed financial advisor. You should always do your own due diligence before you invest in anything. But what do you do with a dividend king like Target when it drops? Well, we have seen a couple of stocks this year already in the DGI Crab portfolio take some massive one-day hits. Nike, back at the end of June, dropped more than 20%. It's still in the process of recovering. We saw Genuine Parts Company, GPC, a few weeks ago report disappointing earnings, and they dropped more than 20%. They are in the process of recovering, and now we're seeing it with Target. So, how do I look at this kind of thing? Well, if you're new to the channel, I am all about acquiring passive income by focusing in on only the highest of quality stocks. I've curated a list of a total of 60 stocks and then split those up into 4 separate categories based on the age of the investor. The dividend yield and growth rate is a major emphasis for me and how I decide what I think is the right age to invest in particular stocks. So Target is in my tier 2 category, which is for investors aged 31 to 41. I've added a little bit of Target already this year. Obviously, at the moment, I am down a little bit on that position. But what happened? So the Target CEO here at Yahoo Finance said guiding for some conservatism as the retailer misses earnings ahead or estimates ahead of the holidays. So on Wednesday, the retailer giant badly missed third quarter Wall Street profit forecast, slashed full year guidance after raising it the previous quarter, and took a cautious stance on holiday sales and profits. Target stock sank 21.9% in the session. By contrast, its rival Walmart beat expectations again significantly in quarterly same-store sales performance, online sales growth, and overall narrative to investors in its own report on Tuesday. Target's been slashing prices on food and other everyday essentials this year in a bid to compete. On a call with reporters, Target execs offered up little explanation for the U-turn in results, except to note that consumers are spending cautiously in more discretionary departments such as home goods. The company also felt the brunt of unplanned costs in its supply chain as it added more inventory than it sold in the quarter. Never a recipe of success for the retailers. So I have read some about, there's some speculation that the dock workers strike pretty recently was something that had a pretty negative impact on Target, but it certainly hasn't done anything to slow down Walmart, obviously. But I also see, there's other stocks that I don't necessarily track really closely because they didn't make the final cut for my top 60, but Dollar General stock hasn't performed well at all this year. I think Costco's done all right. That one's been a pretty good one, but it's just been kind of a retail environment that seems pretty dominated by Walmart and Costco this year. And we could sit here and speculate all you want, but you could just say prices of things have gone way up and consumers are looking for deals, and Walmart definitely has its reputation for offering really low prices. And then of course with Costco, you can buy your household goods and whatnot in bulk and save a lot of money that way. So places like Target are really feeling it. So let's zoom out a little bit here. I'm going to go to Seeking Alpha, take a look at the Target stock. You can see here it's down to $120.76 per share as of right now. Down on the year, 6.86%. Let's see, on the year to date, down 15.5%. If we zoom out to the 5-year, down 4.5% on the 5-year. And then finally on the 10-year, it is still up 63.18%. So if we're talking about age 31 to 41-year-old investors that are adding stocks to get them passive income to march them toward retirement, you probably have still a little bit of a longer time horizon. So keeping in mind the 10-year chart is something that you are not going to want to ignore. Now, certainly there have been other stocks that have done better than 63% gain over the 10-year chart. But if we look at this and we say, well, over the 5-year, it's actually down a bit, but on the 10-year, it's way up. That's the kind of difference that an extra 5 years in the market can make. Now, let's talk about the dividends here for just a moment. So Target pays an annual dividend of $4.48 per share. So every share of Target you get, you're increasing your annual forward dividend income by $4.48. They have a 5-year growth rate of better than 11%, and they have increased their dividend for 56 consecutive years. This is a firmly ensconced dividend king. The dividend kings can have their streaks broken. It's not totally out of the question that you see a dividend king, slash their dividend or break that streak in some way. Seeking Alpha is going to have to refactor and update the payout ratio right now to factor in the adjusted guidance of the third quarter numbers. And so I'll be waiting to see what that looks like. But what I want to do is let's go back a little bit, take a look at the dividend growth history of Target. So this past year, the dividend growth rate was really small, less than 2%, kind of disappointing based on what they'd been doing in recent years. But then you can see the previous 3 years from that, we had big time dividend increases. We had a 10-year increase in 2023. We had a 25% increase in 2022. That one was massive, just shy of 18% in 2021. And then we had a few years pre-COVID, basically 2020, 19, 18, of fairly modest dividend increases in just the 3% range. And then a few years prior to that, there were double-digit dividend increases. So sometimes with a consumer shopping type of stock like Target, sometimes the dividend increases can be a little bit hit or miss. They can be somewhat cyclical. Target may be pretty conservative with its dividend increases on a go-forward basis into 2025 until they can get better earnings. But that being said, it does have that very long history. So just because a stock has a 5-year growth streak of 11% on average, that doesn't mean that they grow at 11% a year like clockwork, just like S&P 500 grows on average 11% a year. Well, some years, like this year, S&P 500 is doing way better than 11%. In other years, sometimes it even goes down. And just over the long course of time, you get sort of an overall level of predictability. So the way I look at it is simple. Unless they announce a dividend cut, which I would be very, very surprised if Target does so, because again, 56 years of dividend increases. Unless they announce a dividend cut, the stock price may have dropped, but the annual payout still stays the same. So a week ago, you could have gotten $4.48 of annual forward dividend income for around $150 for a Target share. Now you can get it for about $120. This is like getting a great deal on a rental property, great deal on a car. You want to make a lot of your money on the actual purchase. You want to get a good deal on that. And Target, as I pull up my spreadsheet here and we look at the stocks in the tier 2 category, Target has now moved into the number one, has moved into the number one most undervalued stock in the tier 2 category at 61% undervalued. How do I get this metric? I'm comparing the 4-year average yield to the current day yield. The 4-year average yield for Target is 2.3%. That's average, right? That's just kind of the standard. And when they plummet like this and that yield shoots all the way up to 3.71%, that to me looks like an opportune time to buy, because I want my yield on costs to be as high as possible. And if I'm used to getting a stock that usually yields in the mid to high twos, maybe let's say at purchase point, but now I can get it in the high threes, that doesn't seem like a terrible deal to me. Now, big reason why I like to buy stocks like this when there is bad news, when there's a lot of fear in the market and people are jumping out, they're jumping ship on that bad news. I just look at the overall long-term track record and say, well, it may be bad now, but there's reason to believe it's going to be better in years into the future. And again, if we have a stock market correction at some point, and I shouldn't say if, but when, and a lot of S&P 500 stocks take a dive and they all start going down, 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 if you're emphasizing your new money on stuff that's already down quite a bit, then in theory, your overall share price shouldn't have quite as far to fall, because you've only been adding stuff when it was already low to begin with. So that's what I try to emphasize. I already did my share purchases for the week for the DGI Crab portfolio. I'll go ahead and show you guys what I did real quick while we're here. And I absolutely would have added Target if I hadn't already committed to my purchases for the week on Tuesday. I did a little early this week, and then, hey, that's just kind of a lesson to me. Always keep a little bit of dry powder ready, right? A little bit of cash on hand to take advantage of deals. But I went ahead and invested my $100 a little bit early this week, and I added to Hershey my 4 ETFs for the Tier 2, VIG, VOO, VYMI, VBR. And then I kind of continued to just trickle money into Nike from the Tier 1 category, ADM from the Tier 3, because they were both yielding 50% higher than their 4-year average. And I continuing to add on to this position in Pepsi, which is one of my top 10 favorite stocks. I'm wanting to add to that while I think that it is a decent enough value to get. Now, my $100 I put in added $2.54 of dividend income to my portfolio, which is a little bit higher yield on costs that I've been used to getting, just a little bit. But all of that to be said, if I had made my investments today, or if I'd done it tomorrow, Target certainly would have been a part of that purchase as well. I think that it's a great deal right now. Typically, when I'm buying stocks, there's going to be a lot of people out there that tell me, no, are you crazy? Don't buy that. Did you not see the earnings report? Did you not see that negative headline? Do you not know what's going on? Absolutely, I do. Bad news is what creates excellent value and buying opportunities when you are narrowing your focus down to a smaller subset of really high quality stocks. That is the name of the game. If you're buying them when it's just all good news, all great earnings reports, great things are going on left and right, profits are skyrocketing, you're probably buying a stock more than likely when it's a bit overvalued, which means when a negative headline does happen, like what happened to Target here recently, there's a lot of room for that stock to fall. So I personally think that my strategy is quite safe from a share price perspective, because I'm holding off until the share price craters, and then I go in and add to it aggressively and then hold that position long term. That's how I'm doing it anyway. And I'm a Tier 2 investor for the next 11 months, and I am adding up these stocks when they go on sale, because I believe they have a long track record of consistent, pretty high quality dividend growth rate. And if I'm wrong on any of these stocks and they cut their dividend, I'm not going to panic. I've got a fair amount of positions here. I can always sell out of that position and move it into something else at that point that looks undervalued. But I think the target dividend for now is safe, but I'm not expecting 10% plus dividend growth in 2025. We'll just have to wait and see. What do you think, you guys? leave me a message down there or a comment. Are you buying Target stock right now? Let me know what you think. Take care.